So welcome back to Financial Accounting 1, or Principles of Accounting 1. And welcome to my home office. I'm not actually in Paris. That's just one of my favorite pictures of the Eiffel Tower in the background. Purpose of this little mini lecture is to review the solutions for for exam number 1. Some of you did very well. Some of you didn't do very well at all. And regardless if you did well or you're kind of in the middle or you're at the bottom there, it's an opportunity to learn. So I would ask you to please go through this and listen to it and listen to my explanations and try to learn from it. And those things that you got wrong, adjusting your understanding of the topic will no doubt be helpful to you going forward. And yesterday in class, I asked for suggestions of how we could make the course more effective. And I got those suggestions, and I'll report back to you on Thursday on what I plan to do with those suggestions. And one of the things that I'm thinking about is doing a little supplement to the course after each class, where I kind of share with you a little summary of what we learned that day and what might be useful going forward. So if this first video goes well, and I'll look for your feedback on it, I may in fact do more of them for you throughout the semester. So without further ado, let's go to the matter at hand. So here was the exam. Just to remind everybody, there were 20 multiple choice questions, and each one was worth 3 points. And this is pretty much the format I use for the exam. So you'll see the same format on exam number 2 and exam number 3. I take at least one multiple choice question relative to each objective for the course, for the chapter rather. And then I pick one exercise from each chapter that really gives you an opportunity to apply and actually demonstrate what you know with regard to probably the most important topic in the chapter. So let's start with the multiple choice. So number 1, which of the following events cannot be quantified into dollars and cents and recorded as an accounting transaction? So remember, accounting transaction is something that has an impact on the accounting equation. It's got to affect the company's assets, the company's liabilities, or the company's owner's equity, which is another word for capital. And the appointment of a new CPA may be a good thing, but it doesn't actually have an effect on the accounting equation, so it's not a transaction. So the one that is not, or one that cannot, is A. A is an apple. Number 2, the body of theory underlying accounting is not based on. Well, it is based on concepts, principles, and definitions. It is not based on the physical laws of nature. So it has nothing to do with gravity and, MC squared and all those other things from physics and so forth. So it's not based on physical laws of nature. It's based on the underlying accounting theory is based on concepts, principles, and definitions. So the answer is A. 3. The basic accounting equation may be summarized as, yes, it is true, assets equal liabilities plus owner's equity is the basic accounting equation. But remember, I said a few times that you can also think as the right-hand side of the equation as claims against the company's assets. We also had talked about how the owner's equity is a residual quantity, and that if the company is liquidated after all the non-cash assets are converted into cash, and the liabilities that are paid off, that's the amount that goes to the owners. So it's a residual claim. So the answer there is D, isn't dog. All of them are correct. If expenses are paid in cash, then, okay, so when you get transactions like this, where they ask you something that what I think you might want to do is actually draw upon your understanding of journal entries, because if you do the journal entry first, even though they didn't ask for it, you'll be able to evaluate the choices they give you in the context of that accounting equation. So if said expenses are paid in cash, so let's assume we paid $500 worth of salaries. So we debit salary expense, we credit cash. So write that down if you haven't done so already. Debit salary expense, credit cash. And then ask yourself, did any asset increase in that transaction? No. Did any liability be impacted by that transaction? No. Did we increase owner's equity in any way? No. So, but take a look. If we've got a decrease in the asset cash, and so that's the one that is the correct answer. So again, when you get things like this where they won't ask you about both sides of the entry. They may just ask you about one side of the entry. So if you have your little journal entry there to refer to, then you can guide yourself to the right answer. So the fact that we debited salary expense and credited cash, cash is an asset, so assets decrease. So the answer there is D. Income statement. Well, again, think of what the right answer is before you look at the choices. The income statement is the financial statement where we show revenue minus expenses and get net income for the period. And that looks pretty much like D. Represents the revenues and expenses for a specific period of time. So the answer there is D. Credits. So here we're getting into, now we're into chapter 2, the rules of debits and credits. So the accounts on the left-hand side normally have debit balances. The transactions on the right-hand side normally have credit balances. So it's asking you about what a credit can do in terms of the rules of debits and credits. Well, decrease both assets and liabilities? No, because we know that credits, if it's an asset, a credit is going to decrease it. And if it's a liability, a credit is going to increase it. Oh, I think I just answered the question there. So the answer is B. So if you still screwed up on that one, take a look at that key slide on the rules of debits and credits. So credits could be either a decrease in an asset or an increase in a liability. 7, the normal balance of any account. Normal balance of any account is going to be the whatever side actually increases the account. So if you want to increase an asset, you debit it. Therefore, the normal balance of an asset account is a debit. You want to increase a liability or owner's equity. If you want to increase it, you credit it. So therefore, the normal balance of liabilities and owner's equity is credit. So with that in mind, the normal balance of any account is left side, right side, and it's going to vary in terms of what type of account it is. But there's what I was looking for. C, the side that actually increases the account. That'll be the normal balance. Number 8, how to do some high-level math here. This one has to do with the accounts payable accounts. So what I would suggest you do here, if you haven't done so already, do a little T account, just write it down. So put down a T account. This is for a liability account. And it says, has an accounts payable as of October 1st, they have an accounts payable of 50,000. So put that over on the right-hand side or the credit side. The company made purchases of 35. So put that over on the right-hand side on the credit side. So add 35 there. And they made payments of 48. So if you make a payment against a account payable, you're going to reduce the liability. So put 48,000 over on the left-hand side. Now draw a line below the T account, and you'll see that we have a credit balance in accounts payable of A, 37,000. So it's the beginning balance of 50 plus the additional purchase of 35 minus the payment of 48 will give you 37,000, which is A. Number 9, the record of activity of the entire group accounts is maintained by a company, is called this is the general ledger. This is the activity of all the accounts. So we have a chart of accounts, which is a listing of all the accounts. The transactions are recorded in the general journal. Yes, we do a trial balance at the end of the period, but where we keep record of all the accounts maintained by the company, the book of the accounts is actually called the general ledger. So the answer there is C. Trial balance. Trial balance is the little record. We take a look at the general ledger at the end of the month. We go and we put down all the accounts and their balances. We want to make sure the debits equal the credits. So they're asking us which of these things a trial balance may, trial balance even when each of the following occurs, a trial balance may balance when each of the following occurs except. So what they're really asking here is which one of these things would cause the trial balance to be unequal. Now, there are limits. All the trial balance shows is that the debits equal the credits. There are a whole bunch of errors that we could make that wouldn't cause that trial balance to not balance. So if we forget to record a journal entry, then we're missing both the debits and the credits. So that's not going to cause it to not be in balance. We like an entry so much we post it twice. As long as we post the same debit and the same credit, it's not going to affect the balance of the trial balance. Debit's not equal to credit. Incorrect accounts are used in journalizing. No, as long as we put a debit and a credit, trial balance is still going to balance. The transposition error is made. Well, the transposition means that you recorded 79 as 97. So if you make a transposition and you make the transposition when you actually do the posting, transposition would cause the trial balance to be unequal. So the answer there is D as in dog. Time period assumption. Time period assumption. I told the story about the guy who wrote the accounting textbook, The Applied Theory of Accounts, the guy who was a monk, a drinking buddy of Leonardo da Vinci's back in those days, where they would get a group of investors together, build a ship, send it to the Orient, pick up spices, bring it back, sell the spices, sell the ship, and so forth. That would take years. So it used to be that you did an income statement at the end of the business venture. Well, in modern society, we have to do it for a period of time, and the maximum period of time that we've lasered in on is 1 year. But any period of time that we actually divide a company's operations is really kind of an artificial allocation that we do to meet expectations of governments and investors and so forth. So the time period assumption is we make an assumption that we can divide the company's operations and the financial reporting into artificial time periods. We say artificial time periods because unless the business is liquidated, the company is still in business. So the maximum time period would be a year. We do, big companies do quarterly financial statements. Sometimes management likes to do them monthly and so forth. So time period assumption is when you assume that you can take the business and you can divide it into artificial time periods. So the answer there is D. The fiscal year of a business is determined by IRS sets tax laws. Lottery is, it's whether you think that's a good thing or a vice, I'll leave that up to you. SEC, that's the government agency that oversees financial reporting in the United States and the trading of securities. The person who determines, or the entity that determines the fiscal year, is the business itself. This is why most big retailers I shared with you will have their fiscal year end January 31st, because it's after the Christmas season. That's probably the low point in their year. So the business chooses its own fiscal year. So the answer there is C. 13, the balance in supplies accounts on June 1st was $5,000. Again, set up a little T account here. So you got an account called supplies, put 5,000 on the left-hand side. Supplies purchased during the year were 3,000, put that on the left side. And now supplies on hand are June 30th were 3,500. So you've got to come up with the adjusting entry for that. You've got to bring the balance of supplies down from 8,000. Where did I get the 8,000? That was the amount on hand and the amount purchased. So that gives you 8,000, 5,000 plus 3,000. And you've got 3,500 left over at the end. So you've got to make an adjusting entry, bringing the $8,000 balance down to 3,500. And that amount is 4,500. So the answer there is B. Good idea whenever they ask you transactions having to do with numbers, actually set up the little T accounts. Failure to prepare an adjusting entry at the end of the time period to record an accrued expense. So in order to answer this question, you got to visualize an actual adjusting entry that would be an accrued expense. So let's just make one up. Let's say that we have unpaid salaries at the end of the month of $300. So we debit salary expense, we credit salaries payable. Write that down. Debit salary expense 300, credit salaries payable. Okay, so you write that down. Now, if you forget to make that adjusting entry, net income would be understated. No, net income would actually be overstated because you would have forgotten to include the salary expense. An overstatement of assets and an overstatement of liabilities. Well, if you forgot to record the transaction, you've actually understated the liabilities. How about this one? C, an understatement of expense. Well, if we don't make the entry, if we forgot to debit salary expense, and an understatement of liabilities. Well, if we forgot to make the entry, we didn't credit the liabilities. So C, just look at your entry there. You debited salary expense, you credited salaries payable. So if you forgot to make that entry, you understated the expenses and you understated the liabilities. And let's, for completeness sake, take a look at D, an overstatement of expenses. No, because if you forgot to make the entry, you actually understated expenses. Okay, the last question here from chapter 3, which of the following statements related to the adjusted trial balance is incorrect? So the adjusted trial balance, you remember on the worksheet, is the trial balance that we prepare after we got the beginning trial balance, we've got the adjusting entries, then we've got the adjusted trial balance. So they're looking for the answer here that is incorrect. So does it show all the balances of the accounts at the end of the accounting period? Yes, it does. It shows them after adjustment. Take a look at C. It proves the equality of the total debits and the total credits is in the ledger. Proves the equality. No, the equality of the total debits and the credit balances in the accounting ledger. That would be the trial balance. That would be the purpose of the trial balance, not the adjusted trial balance. Financial state. I'm sorry. C would actually be correct. It does prove the equality of the debits and the credits in the ledger. It's the balances after the adjusting entries, but yeah, the debits equal the credits. D, financial statements can be prepared directly from the adjusted trial balance. That's true. The one that is incorrect that we're looking for here is prepared before the adjusting entries have been made. No, by definition, the adjusted trial balance is the trial balance after the adjustments are made. So A is true, C is true, D is true, B is incorrect. So B is the answer you're looking for there. And now 16 through 20 have to do with chapter 4. What is the worksheet? Remember, we said the worksheet is not a financial statement. It's not a permanent accounting record. It's not part of the general ledger. It's not part of the general journal. It's an optional device used by accountants to help them prepare the financial statements. And that is indeed the right answer there. 16 is B. Closing entries, sometimes known as salmon entries. Why do we make closing entries? Well, we make closing entries to bring the balance of the revenue accounts and the expense accounts down to zero, by transferring them initially an income summary and then the balanced income summary to capital or to owner's equity. And we've got a closeout drawing as well. Remember, there are 4 closing entries. First, we close out revenue, then we close out expenses, then we close out income summary, and then we close out drawing. So closing entries are made. So let's take a look at the choices here. In order to terminate the business, no. Business, so we have a reasonable expectation the business will continue in business indefinitely. So that assets, liabilities known as capital accounts will have zero balance. Well, those are your terminate accounts, so you don't want to close those out. C, in order to transfer the net income or loss and owner's drawing to the owner's capital account, that is correct. That's why we do closing entries. So the financial statements can be prepared. Well, we do the closing entries after the financial statements are prepared. So 17, the answer is C. Another question about closing entries. Well, why do we make closing entries? The closing entries bring the balance of the temporary accounts down to zero. Are prepared before the financial statements? No, we do the closing entries after the financial statements. Reduce the number of permanent accounts? No, we don't do anything to the permanent accounts with the closing entries. It's the temporary accounts. Cause the revenue and expense accounts to have a zero balance. That sounds good to me. That's the correct answer. Summarize the activity in every account. That's just put there as an alternative. There's no basis for that one. So the correct answer there is C. Closing entries bring revenue and expense accounts down to zero. 19, the final step in the accounting cycle. That's the little Jacob diagram there. So the final step on that long list of things that we do is to prepare a post-closing trial balance. That's the end of the day. That brings all the revenue and expense accounts and the temporary withdrawals account down to zero. We get ready for the next year. So the final step is the post-closing trial balance. And intangible assets, intangible assets, copyrights, patents, and goodwill. They are a section on the classified balance sheet, which we did in chapter 4. So they're asking you which of these things is correct. Let's take a look at A. Do not have physical substance, yet often are very valuable. I would say that is true. So if you look at your computer, if it's got an Intel inside, it'll have a little Intel thing there. I have a Lenovo computer and there's the name Lenovo on the computer. There's lots of patents that are in this computer and so forth. So intangible assets are things that may lack physical substance, but they are very valuable. Patent rights, patents, copyrights, goodwill being an example. So A is definitely correct. B, say it's worthless. Well, if it's worthless, it wouldn't be on the balance sheet. It's converted into a tangible asset during the operating cycle. No, cannot be classified in the balance sheet because it lacks physical substance. That's not true because we know there are intangible assets on there. So the answer to 20 is A. All right, so those were worth 3 points apiece. Now, maximum you could have gotten on each of these short little exercises here was 10 points. So this one here is taken from chapter 2, and what we need to do is we need to just come up with the journal entries. Now, some of you had an interesting interpretation of journal entries. Every journal entry has to have both a debit and a credit, and you have to indent the debit and the credit, and the debit has to come first. So the owner invested $38,000 cash into the business. You have to ask yourself, what accounts are involved? Are they increased or decreased? And how do I record that in terms of debits and credits? So the owner invested $38,000 in cash to start the business. So we increased the asset account cash by debiting it. And it was from the owner's investment, the owner's capital. So we credit owner's capital. So that's the first one, is the journal entry to record his investment in the business. B, hired an employee to be paid $500 a week starting tomorrow. Hiring an employee has no effect on the accounting equation. Remember, the accounting, in order for a transaction to be recorded, it's got to affect either the asset account, a liability account, or an equity account. And hiring an employee is not a transaction. Nothing has happened yet. We'll recognize the expense of the employee when we start to pay the employee. So no entry is required there. Number 3, pay 2 years rent in advance, $10,800. Well, if you pay rent in advance, that's an asset account called prepaid rent. And if you want to increase the balance of an asset account, you have to debit it, and then you have to credit cash. Number 4, paid the worker's wage $500. Well, if you want to increase the balance of an expense account, you debit it, so salaries and wages expense, and you're paying him in cash, that reduces the balance in cash. The asset account is a credit to cash. Number 5, recorded revenue earned and received for the week, $2,900. So you're increasing the asset account cash and you're increasing the revenue account. Right? So again, some of you struggled with debits and credits. Where you struggled is that each transaction has to have both a debit and a credit, and the debit has to come first. And when you record the transactions, you got to be consistent with the rules of debits and credits. That was one of the key slides that you have from chapter 2. Number 3. So this is a trial. These are Kitman prepares monthly financial statements. Here are the account balances at the end of September from the trial balance. So these are your account balances, and then you're given this additional information. So your general ledger balance for supplies is $3,200, but your physical count of supplies is $1,400. So if you've only got $1,400 left over and you had $3,200 in the trial balance, that's going to require an adjustment. And the adjustment is going to be a debit to supplies expense and a credit to supplies. That brings the balance of the supplies account down to the amount that you actually have on hand, which is $1,400. 2-year insurance policy was purchased on September 1st. 2 years of insurance for $3,600. If you divide $3,600 by 24, because there are 24 months in 2 years, you're going to get $150 a month. We purchased the insurance policy on September 1st. We're now at September 30th. So you have 1 month's worth of insurance expense you have to recognize. So we debit insurance expense, we credit prepaid insurance. 3, the equipment depreciated for $3,300 per year. Well, for full year depreciation would be $3,300. We've only got 1 month, so you got to divide the $3,300 by 12, and that gives you $275. So debit depreciation expense, credit accumulated depreciation. You do not credit the asset directly, you credit the contra account. And then the last one here, the amount of rent received in advance remains unearned at the end of the month of $700. So you had $1,200 in unearned revenue, which means you had revenue you had received in advance. So the fact that it's received in advance, you're picking it up as a liability. But now they're telling you that the amount that is still unearned is $700. So you got to bring that balance of that liability account from $1,200 down to $700. And you do that by debiting unearned revenue and crediting rent revenue. Number 23, use the following income statement for the year ending 2020 to prepare entries to close the revenue and expense accounts. That's all I wanted to do. There were 4 closing entries. I thought I'd be a nice guy. I only asked you for 2. Close out the revenue accounts, close out the expense accounts. So the revenue account we have is service revenue. So I debit service revenue, I credit income summary. That brings that revenue account down to 0. And then to close out the expense accounts all have debit balances. So you're going to debit income summary and you're going to credit the individual expense accounts. I only asked for 2. The next one you would have had, if I had asked for it, would have been a closeout the income summary, because income summary has a debit of $61,200 here and a credit of $85,000 there. So the difference between those is $23,800. So if I asked for the third closing entry, it would have been a debit to income summary and a credit to capital or owner's equity. And we would have also had to make an entry to close out the withdrawals account, but they didn't tell me what the withdrawals were. So although there are 4 closing entries, I only asked for 2. Here's the one to close out revenue. Here's the one to close out expenses. Another topic in chapter 4 was the classified balance sheet. And notice in the practice exam, I had you prepare a classified balance sheet. So here I figured I'd make it easier for you, bearing in mind this was your first exam. So I didn't ask for the full balance sheet. I just asked for the prepare the current asset section of his balance sheet. So the current asset section of his balance sheet, you'd have to look at those accounts and say which of these are current assets, and you want to put them in order of liquidity. So remember, the current assets are all those cash are something going to be converted into cash within 1 year. So with that definition, cash can be converted into cash within 1 year. The most liquid of the assets is cash, followed by accounts receivable, followed by supplies. Some of you had strange things in there. Some of you put service revenue there, and some of you had equipment in there. Remember your classified balance sheet. You need to know not only what type of account they are, but where they show up in the classified balance sheet. So as you review this, I would not only look at this one, look at the review I gave you on the practice exam. I actually posted the solution for you on the practice exam. That you need to recognize, what's a current asset, what's property, plant, equipment, what's an intangible asset, what's a current liability, what's a long-term liability, and so forth. All I wanted here was the current assets. Okay, so I hope you found that review useful. There are things to be learned. We learn as much in life from our success and failures as we do from our victories. So those of you who did extremely well and had a victory, kudos to you. I would ask you to share your experience with some of the people who didn't do as well. Maybe we'll have an opportunity to do that in class on Thursday. And those of you who didn't do well, ask yourself, what can you be doing differently to improve your performance in the course? And perhaps as important, what can I be doing to help you reach your full potential in terms of learning the material? All right. So until next time, adios, au revoir, hasta luego. We will see you soon. Bye-bye.